Mortgage rates in the US began climbing when the Federal Reserve started hiking its policy rate in early 2022 and now stand near levels not seen in more than 2 decades. While the impact of higher rates on affordability would seem to be a headwind to the housing market, demand has continued to outstrip supply and send home prices ever higher. We believe the skewed supply demand dynamic represents a structural shift in the US housing market that emerged with the global financial crisis and was exacerbated by COVID-19. As a result, residential housing supply is constrained in the US. Housing stats have lagged household formations consistently for nearly a decade, while homeowners locked into rock bottom mortgage rates available during the COVID period have little incentive to sell their homes. At the same time, regulatory changes have prompted commercial banks to pull back from certain types of real estate lending. All told, these developments have created durable opportunities for private lenders to provide liquidity to the real estate market and potentially generate attractive long-term returns for clients. We believe there are compelling opportunities to be found in both private and public investments related to real estate debt. On the private side, the yields on residential transition loans and homebuilder finance transactions offer investors attractive complexity and illiquidity premia over traditional credit assets like leveraged loans and high-yield bonds, alongside short durations and robust cash flows. Meanwhile, certain real estate-backed securities in the public market may serve as attractive complements to such private market exposures. These include the credit risk transfer securities issued by agencies, as well as instruments like mortgage insurance and non-qualifying mortgages. Investors with the flexibility to opportunistically rotate between private and public real estate exposures may be particularly well positioned to capture the benefits of each, while also exploiting the relative value discrepancies that periodically emerge between them. Specialty lending channels tend to have high barriers to entry, however. We believe experienced sourcing, underwriting, and structuring capabilities are essential for those looking to leverage the ample opportunities we believe exist in residential real estate debt.